We now come to section 5, multi-stage dividend discount models. First, some high-level remarks here. Most companies experience varying phases of growth, and as we've said several times, the CFA Institute likes life cycle related depictions because the way you analyze companies depends on what their stage is. So obviously, the cash flows for a company in a growth phase will be very different from the cash flows of a company in a mature phase. In the growth phase, generally the growth rate will be relatively high. The FCFF, or the free cash flow to firm and free cash flow to equity, might be negative. Often the dividend payouts are low. Then there is a transition phase where growth rate still tends to be above average, but the earnings might be growing at a lower rate. So here in the growth phase, earnings might be very high or sales might be very high. Then in the transition phase, we are like this. And finally, we have a mature stage where the return on equity generally starts approaching the required rate of return. This is the equilibrium stage. The growth and dividend payouts stabilize. And this is where we use the Gordon growth model. Section 5 is quite important and testable. We talk about several different kinds of dividend discount models over here. So let's start with a basic two-stage DDM. In a two-stage DDM, as the name implies, we assume two distinct phases of growth. A high growth phase for an initial short term, and then a sustainable and usually lower growth rate thereafter. The curriculum gives a somewhat complicated looking formula, which is actually very straightforward, and I'll explain this through a simple example. Let's say that you have a company where the expected growth rate for 3 years is 20%. The 20% is denoted by GS, which stands for the short-term high growth rate. So in a simple example, let's say that this is 20%, and say that we expect this to happen for 3 years. So how do you draw this out? 0, 1, 2, 3. If you have a given dividend D0 over here, this is the existing dividend or the dividend just paid, then how do you come up with D1? D1 will be D0 into 1 plus G, where G is 0.2, and then D2 will be again taking D1 and increasing that by 20%, and D3 will be taking D2 and increasing by 20%. Then after this stage, the company keeps growing but at a lower rate. That lower rate is denoted by GL, where L stands for long term. Let's say that that rate is 8%. So what is this formula trying to say? What this formula is trying to say is the following, that to value this company, we still use the basic concept that the value at time 0 is the present value of all future dividends. Can you use the Gordon growth model with D1, D2, D3? You cannot, because for Gordon growth to work, you need to assume a growth rate of a certain number forever. Here we have 20%, but for a finite period. So what do? You take D1 and discount it back, D2 discount it back, D3 discount it back, and that is what this part of the formula is saying. Then what about this part of the formula? What this is saying is that you will have a certain dividend D4, and given the numbers that I have just described, how do you come up with D4? D4 is equal to D3, which is essentially D0 into 1 plus the short-term growth rate. So this, in my example, is D3. And then from D3 to D4, you essentially have a growth rate of GL. So multiply D3 by 1 plus 0.08. And then once you have all these dividends, you have D4 and so on, how do you come up with value at time 3? Value at time 3 is simply equal to D4 divided by R minus G. And which G is this? This is the long-term growth rate, which is this point over here. And that is all we are really doing. Instead of focusing on this formula given in the curriculum, I would encourage you to think about this particular concept. If you try to memorize this formula without understanding what's going on, that is a recipe for disaster. So let us look at an example which is conceptually simple, but unless you have a lot of time, I would actually not encourage you to work through all of this, and you will see why. There is a lot of calculation involved here, and in the real world, you'll do this using a spreadsheet. In the exam world, they are not going to give you something where you have to take 10 different cash flows and plug them into a calculator. They might, but I think it's unlikely. So I'm going to emphasize the concept, and then if you've understood the concept, then you'll be able to do practice problems. So you have a particular company, and here is what you are told. The current dividend, so at time 0, we are given a D naught of 0.14, and we are told that this will grow at 15% for 10 years. So what does that mean? You have period 1, period 2, and so on, all the way up to period 10. Can you compute D1? This is straightforward. It's 0.14. 0.14 growing at what rate? 15%. Similarly, you can compute D2 and so on, all the way up to D10. If you do end up getting a question like this on the exam, what should you do? You should use the cash flow register and then plug in D1, make that cash flow 1, and then multiply it by 1.15, and then the new number becomes cash flow 2, and so on. So you plug in the 10 numbers into your calculator. Then after year 10, what happens? The growth rate will then be 8%. So from here on, the growth rate is 8%. So from D11 and beyond, can we use the Gordon growth model? We can. What's the value at time 10 based on the Gordon growth model? It's going to be D11, which you can calculate because you know D10, and then D10 into 1.08 is D11, divided by the discount rate, which is given 9.7% or 0.097, minus the long-term growth rate, which is 8%, that's the G. So this will give you V10. And then how do you come up with the value of the company? It's the discounted value of D1 through D10, and then the discounted value of V10. So it is fairly straightforward. And this fairly straightforward calculation is shown over here. They have computed all the dividends, and then they have taken the present value of all 10 dividends. They have computed V10 using the method that I just talked about. So this is up to here is D10 multiplied by 1.08 makes it D11, divided by R minus G gives you the value at time 10, and then the value at time 10 is discounted back. A recurring theme is that the overall value that you come up with at time 0 consists largely of this terminal value. So most of this number, 16, is coming based on the value at time 10, and therefore it is very sensitive to the assumption you make about the long-term growth rate. And if you think about it, you are making an assumption about a growth rate that will start after several years, after 10 years in this example. So it is very easy to make an error, and therefore you cannot be too confident about your valuation. All right, here is another example that is largely similar. Actually, what I'll do here is I want you to try this because this is quicker and more indicative of what you might see on the exam. So do this and then I'll go over the solution. So here's what you do here. The first dividend end of year 1 is 1.63. That is simply based on the numbers given, growing at 10%. You can come up with D2, D3 and D4 based on the 10% rate. And then at time 4, we will use the given PE ratio to come up with what the value of the stock is expected to be at the end of period 4. So in addition to these 4 dividends, we also have a value at the end of period 4. Assuming that the value is a non-biased or unbiased indicator of the price at the time, we can say that the value at period 4 is the PE ratio, the trailing PE ratio at period 4, multiplied by the earnings for period 4. The trailing PE ratio over here at the end of period 4 is 14, that's given. So P4 over E4 would be 14. And then the value or the price would be the PE ratio into the earnings. The question is which earnings? And given that we are using a trailing ratio over here, it should be the earnings for the trailing year, which in this context would be the 4th year. So how do we come up with E4? Remember, we are given the payout ratio, which is 40%. So 40% of the earnings for year 4 would be equal to the dividends for year 4. We have computed the dividend for year 4 as 2.17, which means that the earnings for year 4 would be 2.17 over 0.4. And you plug that over here. The value at the end of period 4, which is our estimate for the price at the end of year 4, is the PE ratio, the trailing PE ratio of 14, multiplied by the earnings for period 4, 2.17 over 0.4, and when you solve, you will get approximately 76. So as an investor sitting at time 0, you can use 5 cash flows, and this is what you would plug into your cash flow register. Cash flow 1 is 1.63, cash flow 2 1.79, cash flow 3 1.97, and cash flow 4 would be this dividend of 2.17 plus the value of 76. The sum of the two numbers would be cash flow 4, and then using a discount rate of 10.5%, you will compute the present value at time 0. And if you do this correct, the answer that you should get is 56.72. If you look carefully at what they've done, it's essentially the same as what I'm talking about, but I encourage you to use the timeline and use the cash flow register and think intuitively about what's going on rather than simply plugging in formulas. Okay, here is another straightforward example. Very often companies during the growth rate actually do not pay a dividend. So what do you do there? Same concept, you model out your cash flow and then discount back. So here is what you do, and this is simply catching you on a very simple point that I hope you realized at level 1. And chances are you did realize, else you probably won't be here at level 2. The dividend at the end of year 5 is 1, and this is growing at 5%. So what you do is use the Gordon growth model to come up with the value at the end of year 4, which is 1 divided by R minus G, 0.11 minus 0.05. You come up with V4, and then that V4 needs to be discounted back 4 periods to time 0, and the answer you should get is 10.98. The classic mistake that students make at level 1 is when they use the Gordon growth model, they come up with the value, they say that the value is at period 5, and then they discount back 5 periods. But I hope you are beyond that, and you recognize that when you use the Gordon growth model, the value that you get is 1 period before the dividend that you plug in the numerator. All right, something new now. This is sort of new, but conceptually it is similar to what we are talking about, the H model. The H model is a variant of the 2-stage model wherein growth begins at a relatively high rate and declines linearly through the supernormal growth period until it reaches a normal rate at the end. So this is what we've done so far, and if we think about it, it's quite unreasonable. if you assume that the growth rate is 20% and it will eventually come down to 8%, what we have assumed so far is that 20% is the rate for a certain number of years, and then suddenly the rate comes down to the long-term 8%. Obviously, I'm just picking numbers here. What is more realistic is that if you think about growth on the y-axis here, that there is a gradual decrease from 20% to an eventual long-term sustainable rate of 8%. And that's what the H model does. It assumes a gradual decrease in the growth rate as opposed to an abrupt fall. So what is the value at time 0 assuming a model like this? This is the formula, and I will help you remember this formula. This formula has two parts. The left side, d naught into 1 plus GL over R minus G. The GL stands for the long-term growth rate. And then everything else here is obvious. D naught is the dividend at time 0, so the dividend that's just been paid. GL, as I said, is the long-term growth rate, which would be 8% in my example, divided by R minus G. So does this look familiar? This is nothing but the Gordon growth model, and this is saying that one major component of the value at time 0 is the value assuming that we grow at 8% forever, starting now. But for a certain number of years, let's say that the certain number of years is 10. For a certain number of years, the growth is more than 8%. So obviously the value of this company is going to be more than what a simple GGM will tell you. And that is the right part of this expression. And what do the symbols here mean? D naught is the same, it's the dividend at time 0 multiplied by H, and this is where the term H model comes from. H is half of 10. 10 here is the number of years it takes to come down from 20% to the long-term sustainable rate. So H is half of that time period, which in our example would be 5. And then GS minus GL. GS stands for the growth rate in the short term. So it is actually the initial high growth rate of 20%. Minus GL is the number from before, which is 8%, over R, which is our required rate of return, and GL, which is our long-term growth rate, 8% in our example. So in order to memorize this, just remember that this part of the expression, the left part of the expression, is exactly GGM. The right part is like GGM. The denominator is exactly the same. The numerator has the H. That should be easy to remember because this is the H model. Also, it has a D naught like GGM. The difference is that you multiply GS minus GL, which is telling you this distance over here. If this distance is a lot, then that would mean higher valuation. And that is why this is in the numerator. Also, if H is high, that means that you are above this 8% for a longer period. That also would imply a higher valuation. So if you get that basic intuition, it will help you remember the formula. And again, stare at this and make sure you can remember the formula. When you plug into this formula, you will get the value at time 0. And I want you to remember this because you will use it on the next slide. All right, now this is an excerpt from example 16. I've just picked the main points. I want you to use the formula that you just learned to come up with the value at time 0 for this firm. So here is how I would like you to do this. Just quickly sketch this picture, which shows an initial growth rate of 24. So this is your GS. The eventual growth rate of 6%, which is the GL. 12 is the time it takes to come down to your long-term sustainable growth rate. So the H is 6, and that's what you will plug over here. And put in all the numbers that are given, what you should end up with is approximately 73.3. Which is shown right here. A classic mistake might be to plug in the full number 12 over here, but remember H is for half, so it has to be half of that number. Moving now to 3-stage dividend discount models. There are several 3-stage models, but two popular ones or two popular versions which are described here. In the first version, the company is assumed to have 3 distinct stages of growth, and the growth rate of the second is typically constant. So again, if you have growth rate on the y-axis and time or number of years on the x-axis, then we say that for a certain number of years the growth rate is high, let's say 20%. Then for a certain number of years growth rate is somewhere in the middle at, let's say, 15%, and eventually the growth rate comes down to 10%. So 3 distinct phases, and in each phase you have a particular growth rate. The second version, which makes more sense, is taking a high growth rate initially and then effectively using the H model. So you are saying that for a few years we'll grow at 20%, and then gradually we'll come down to a long-term growth rate. Let's say the long-term growth rate again is 10%. So notice that we from here on are simply using the H model. For a few years we are at 20%. This might be, say, 3 years, and then after that it's the H model. So how would you solve problems given these two models? The next example will deal with this scenario, and the example after that will deal with this scenario. Conceptually, these are quite straightforward. What will you do with this version? You take each cash flow, each dividend, and discount it back. Then again here you take each dividend and discount it back. And then what do you do here? Here you use the GGM, the Gordon Growth Model. You will have a particular dividend over here. Based on this dividend, let's say that this is year 10, the dividend at year 10 and then the subsequent growth rate of 10%. So all these dividends will be discounted back to get a value at time 9, and then that will be discounted. So exactly what you've seen. What about the second version? Here you will take your 1, 2, 3, these 3 dividends and discount them back individually. And then what is the value at time 3? That will be computed using the H model. So instead of D0, what will we plug in? D2, D3 or D4? We need to actually plug in D3, because remember with the H model, we used D0 and then had a 1 plus G. And here, if we are computing the value at time 3, then you use the H model formula, but instead of D0, you use D3 because you are coming up with the value at time 3. Okay, let's take the 3 distinct stages first. You are given the dividend and then you are given 3 stages. The required return is 12%. Dividends will first grow at 14%, then they'll grow at 12%, then they'll grow at 10.2%. So here's what's going on. For year 1 and 2, we have a growth rate of 14%. So we'll estimate D1 and D2 and discount them back. Then once you have D2, how will you come up with D3? It will be D2 multiplied by 1.12. So you'll have D3, then you can compute D4 and so on, all the way up to D7. So all these dividends will then be discounted back, and you cannot use the Gordon Growth Model again because these numbers are finite. You do not have a growth rate of 12% that goes on forever. So use your cash flow register, plug in the numbers and discount back. And then finally, you compute D8 based on D7 into 1.102, the final growth rate. So you will have D8, and then since 10.2% is going on forever, based on our assumptions, you can come up with the value at time 7 based on the Gordon growth model and discount this back. And that is effectively what's being done here. The answer that you should get is 113.06 roughly. And as we have said before, the terminal value of 101 constitutes the overwhelming portion of the total estimate. Again, emphasizing the point that with these models, if you are making incorrect assumptions about growth rate and so on, that will have a big impact on your terminal value, which will have a big impact on the value of the stock that you are estimating. And then this is the version 2 of the 3-stage model. The current dividend is 0.46. Analyst forecasts an initial 5-year period of 12%. So here initially we are at 12%. He estimates that the company can grow at 7.5% per year as a mature company. So what's going on here? So eventually we'll be at 7.5%. So here is what you do. For 5 years, the company grows at 12%. So you take D1, D2, D3, D4, and D5 with a growth rate of 12% and discount each of those back. And then notice that we are allowing 10 years for the transition. So the transition happens by the end of year 15. The value at period 5 can be calculated using the H model. And in the H model, instead of plugging D0, you will plug in D5. The H is going to be half of 10, which is 5. And the short-term growth rate is going to be 12%. The long-term growth rate is going to be 7.5%. So you will come up with the value of V5 and discount that back also. So here are the numbers. The answer that you should get is 28.6 roughly. Section 5.5 deals with spreadsheet modeling. This is mentioned in the learning objectives. I can't imagine how you will be asked to create a spreadsheet on the exam, but at least you need to know the principle involved here. Spreadsheets allow the analyst to build complicated models that would be very cumbersome to describe using algebra. For example, if you need to compute an IRR for a multi-stage model, that would be hard to do on pen and paper. So analysts in general use spreadsheets like Excel. Built-in spreadsheet functions use algorithms to get a numerical answer when a mathematical solution would be impossible or extremely challenging. Again, IRR would be a good example of that. And then several analysts can work together or exchange information by sharing their spreadsheet models. The formulas are built in there, so the easiest way to communicate is through the formulas that have been built into Excel. I won't spend too much time on this, but you can look through example 19, which is an illustration of how to use spreadsheet modeling. In the real world, this is critical, so make sure you understand this well after the exam. Estimating a required return using any DDM. Effectively, we've talked about this, and I'll just read the critical segment from the curriculum. This reading has focused on finding the value of a security using assumptions for dividends, required rates of return, and expected growth rates. Given price and all inputs to a DDM except the required return, an IRR can be calculated. Such an IRR has been used as the required return estimate. And then a statement that I find amusing and obvious, but people still make this mistake. If you use this technique to come up with the required rate, and then use that required rate to come up with the price of the stock, then that would be a fairly stupid thing to do. And that brand of stupidity is referred to as circularity. So make sure you don't do that. All right, concluding remarks. I hope that this has been obvious as we have covered the various examples, but DDMs have some limitations. Often the present value of the terminal stage represents more than 3/4 of the total value of the share. So very sensitive to your terminal value. The terminal value can be very sensitive to the growth and required return assumptions. We did a little sensitivity analysis and we saw that just a 0.25% change in the growth rate or the required rate can have a 30-40% impact on the value that you compute. And then if you are assuming 10 years for the growth rate to stabilize, how sure are you that it will actually take 10 years? It is quite possible that due to technological innovation and so on, that time period is very different from what you've assumed. Or the growth rates or other variables are very different from what you've assumed. So while you can use these models that look very specific, but recognize the fact that all of them are approximations and they are only as good as the assumptions you make. Section 6, financial determinants of growth rate. So the emphasis of this section is on coming up with the growth rate, which obviously is an important number in our model. There are 3 subsections and we'll go over each of them. Section 6.1 talks about the sustainable growth rate. So how do you come up with this? The most basic way is to estimate the growth rate based on the growth rate of the economy, generally depicted by the GDP, or you might also look at the estimated long-term growth rate of the industry in which your target company is operating. So that's one method. The more testable method, and one that you are likely to see on your exam, something you've also seen at level 1, is based on this simplistic formula. The growth rate is approximately equal to the retention ratio or the retention rate multiplied by ROE. There is an example in the curriculum that illustrates this in detail with numbers. I want to make sure you have an intuitive understanding of this expression. If you think of 2 companies, A and B, all else equal, A retains all its earnings and then invests that money. B pays out all earnings and therefore has a retention ratio of 0. Which company will grow faster, all else equal? Obviously, the company that has a high retention ratio will grow relatively faster. Also, once the money is retained, let's say now we have another situation where you have C and D. Both companies retain 80% of their earnings, so the retention ratio is the same. But ROE of company C is much higher. In other words, the return on the money invested is higher. The company with the higher ROE is also likely to grow faster. So therefore, simplistically, the growth rate depends or has a positive relationship both with the retention ratio and on the return on equity. So make sure you remember this, and hopefully this is not hard because you've seen it at level 1 also. What are some methods of coming up with ROE? The one simple method might be to just look at the company's ROE over the last few years and take an average, as long as you are comfortable that the ROE over the last few years is indicative of what will happen in the future. Another is to go back to one of your favorite relationships, the DuPont relationship, and recognize that you can come up with ROE by multiplying several ratios, which we will see on the next few slides. So you can use the DuPont formula. You can see this in some textbooks that ROE is equal to R. So this applies to companies that are mature and stable, where we are effectively saying that for a mature company, the return is equal to the cost of equity. So if you are in that phase where the company is now mature and the return is equal to cost of equity, then you can simply use R, or the required return, as the number for ROE. And in some books you'll also see the other things happening the other way around, where you estimate the ROE and say this is a stable company, therefore the required return on equity is equal to ROE. You can also set ROE equal to the median or average ROE for the industry. This example illustrates the use of the formula, and you can pause the video and read through it. It is fairly self-explanatory. Dividend growth rate, retention rate, and ROE analysis. So as promised, we are going to go through the DuPont relationship. You remember this, ROE is essentially net income over shareholders' equity. And then this is the first level decomposition, where we say that net income over shareholders' equity can also be written as net income over total assets. Then we further broken into the profit margin, net income over sales multiplied by sales over total assets. So return on assets can be decomposed as the profit margin divided by, this is the asset turnover. And then the financial leverage obviously just comes down. So what does this have to do with G, the growth rate? Remember, the growth rate is equal to the retention ratio into ROE. So what we are saying is that the ROE is coming from the DuPont formula, and this is the retention ratio, which is the net income minus dividends divided by net income. So this is a cumbersome way of estimating the long-term sustainable growth rate. This is also referred to as the Pratt formula, and it is referenced in the curriculum examples. And what does that mean? It is supposed to be an easy way of remembering the relationship. P stands for profitability, so that is this expression. The R stands for the retention ratio, which is over here. A stands for asset turnover ratio, and for reasons that I'm not quite sure, T stands for leverage. So that's the only one that is non-obvious, so just remember that. And then this is an example from the curriculum that I want you to do. The only caveat here that might throw you off slightly is this expression here, equity multiplier of 2. Equity multiplier is another way of referring to the leverage. So what is the formula for financial leverage? It is assets over equity. So this assets over equity is sometimes called the equity multiplier. So you might see the leverage is 2, or you might see this expression, equity multiplier. Other than that, you will notice that it's just plug and play. So you are given the numbers and you come up with growth rate based on the retention ratio, and then 10% into 1.25 for the first company. What is going on here? Remember, one way of using DuPont is to multiply the return on assets by the leverage. So equity multiplier of 1.25 is the leverage. So that's what we've done here. Second company has a higher retention ratio of 66.66%. So that's what we use here. Into what's 10%? That is the same ROA, but the leverage is higher. So notice that the ROE for the second company, Mondale, is higher for 2 reasons. One is the higher retention ratio and the higher leverage, or as they call it, the higher equity multiplier. This is an example that I want you to read through. All we are doing is forecasting growth using the Pratt formula, and as a quick reminder, profitability into retention ratio, into asset turnover, into leverage. Okay, you can read through this when you have time. Financial models and dividends. Analysts can also forecast dividends by building more complex models of the company's total operating and financial environment. Because there can be so many aspects to such a model, a spreadsheet is used to build pro forma income statements and balance sheets. The company's ability to pay dividends in the future can be predicted using one of these models. And with models, you can also change numbers, do sensitivity analysis, and so on. If you have time, then you can look through example 25. What we'll now do is quickly summarize the main points. And it is a fairly long reading, but as I mentioned before, it is relatively straightforward and you've not learned that many new things. The good news is that it is a major chunk of your course, so hopefully if you get a question based on the dividend discount model, you should be able to do well on it. Let's look at the main points. You need to understand what we mean by the DDM and when should it be used. DDM is nothing but the following. You take a non-controlling interest, you say that you buy a particular share, you are the owner of this financial asset, you will get dividends in the future, and you come up with an estimate of the value of this share by taking the present value of all future dividends. That's all there is to it. They are fancy models based on the pattern that you define for the dividend. You might say the dividend will grow initially at a high rate, then at a low rate. You might have H models and so on, but it is nothing other than the present value of future dividends, which is the most basic way of valuing a financial asset. When should this be used? You should be able to use this when a company pays dividends. The dividends have a clear relationship with the profitability of the company. We talked about different kinds of DDMs. The Gordon growth model assumes that the growth rate is going to be constant at a certain level. So as long as your growth rate is constant, your required rate of return is greater than G, then you can use this model. Also, obviously, R is assumed to be constant. Then we talked about the H model, where we say that the growth rate is high, it comes down gradually to a certain level and then stabilizes. So make sure you know the formula for the H model also. We talked about the present value of growth opportunities. The idea here is that the value of a stock or a company can be thought of as having two components. One component is based on the assumption that the company will not grow, in which case the value is E1 over R, plus the PVGO. For high growth companies, PVGO will be a relatively high percentage of the overall value. You need to understand the justified, leading and trailing PE ratio. And these are basic formulas that you've seen at level 1. They are called justified because these ratios are justified based on the fundamentals of the company. Sustainable growth rate, key relationship to remember is that the growth rate is approximately equal to the retention ratio into ROE, and then ROE can be estimated in several ways, and the most testable way probably is the DuPont relationship. And then we also learned about TRAT, which we've done several times, so you need to remember all these terms. The only tricky one is T, which stands for leverage. Estimating implied growth rate and required return using the DDM, all we are saying here is that if you want to compute the implied growth rate, you use, let's say, the Gordon growth model or whatever model, plug in all numbers except G and compute the implied value of G. Similarly, if you want to compute the implied rate of return, plug in all numbers including the market price and figure out what required return is implied by the market price and other variables related to the firm. Often you'll be asked whether the stock is overvalued, undervalued. This is straightforward. You come up with a value based on your model and you compare that with the market price. If the market price is too high relative to your value, then the stock is overpriced. Sometimes you might need to do this based on PE ratios. If the market PE ratio is 20, and you come up with a justified PE of 15, then this would also mean that the stock is overpriced. You don't have to compute the actual price, you can just compare the PEs and decide whether the stock is overpriced or underpriced. As always, I want you to read the summary in the curriculum, go over the learning objectives. There are lots of learning objectives, but we have covered them all. I have covered almost all the examples. The key point is that every example is emphasizing some important idea, and don't get hung up with the mechanical details of calculating the answer. If you do that, that's good, but make sure that you understand the essence of each example, and then do the practice problems at the end. If you have time, do practice questions from other sources. That is it.